Hello and welcome to Learn.Invest.Achieve channel. Today we'll be talking about Designer Brands Inc. ticker symbol DBI, because in my opinion, this stock is worth watching because the return on investment ratio is very high compared to other companies in the stock market. Before we dive into the analysis, I want to remind you that this video is not financial advice and for entertainment purposes only. Also, I go over the annual report or the 10K report for the past few years to understand their business and to collect the financial and non-financial information that I think is relevant to this analysis from all three financial statements, the income statement, the balance sheet statement, and the cash flow statement, to compile it in this analysis report and create visuals to make it easier to understand patterns. Finally, I want you to know that your subscription is what motivates me to make more videos, so please support this channel by subscribing. That will only cost you one click. Designer Brands is one of the world's largest designers, producers, and retailers of footwear and accessories. The company operates 639 stores, 501 stores in the United States, and 138 stores in Canada. They report their operations in a fiscal year that ends on January 28th of each year, so they are not a calendar year. The auditing company expressed positive opinion, or in other words, they think that the accounting team did a good job creating the financial statements, and we can use these statements to perform our analysis and to forecast future numbers. This company has a 4% market share in the footwear and accessories industry. The total industry market for the publicly traded companies listed in the US stock market is about $75.5 billion in 2022. This big rectangle represents the 2022 market of the footwear and accessories industry, and this section is the Designer Brands share of this market. And this over here is 68% of the market, which is for Nike. So you can see the difference between the two companies in terms of revenue. And number 4 is Crocs Inc., which is a casual footwear company. If you're interested in Crocs stock valuation, check out the video right after this one. Moving on to the next tab, when we analyze 2022 revenue, we can find that the company had 3 operating segments. 82% of the revenue came from the United States retail segment, 9% from the Canadian retail segment, and another 9% from the wholesale or international operations. Now let's compare the revenue, the cost of sales, and the net income from 2017 to 2022. This company suffered because of COVID. As you can see here, the revenue in blue went down due to the shutdown, and the net income in gray was reported negative. But we also can see that the company is recovering, because the revenue and net income in 2021 and 2022 are bouncing back. So I think this part of the financials deserve a green check mark. Now let's check the free cash flow graph. The free cash flow also suffered in 2020, which shouldn't be a surprise to you, but it's bouncing back, which is a very good thing for them and for the current investors or shareholders. Scrolling down, let's check their solvency. The debt is only 14% of total assets, which is a great news because they have so much room for future growth using debt. And if you want to be more specific about their solvency, we can check the times interest earned ratio to see how many times the interest expense they made in each year to see if they can afford to service the debt. In 2022, they made 17 times the interest expense. And keep in mind that the interest rate increased by many folds in the past few months. So having 17 times is such a great job for the management. So this part of the analysis should make the shareholders sleep better at night. Next, let's check the outstanding shares to see whether the company is issuing more shares and diluting the investors' ownership, or if the company is buying back their shares to increase the ownership percentage and the earning per share for the remaining investors. And actually, they did a great job from 2017 to 2022 because they bought back about 22% of the outstanding shares, and as an investor this makes me very happy. But reading the 2023 Q1 report, I noticed that they increased their outstanding shares by 3%. Also, in the Q1 report, the company mentioned that they acquired 79% of Topo Athletics and 100% of Kids Company. So that could be the reason for the 3% increase in the outstanding shares in the first quarter of 2023, and hopefully they will not issue more stocks in the future. Moving on to the dividends, in 2018 and 19, the dividend per share was $1, then only 10 cents in 2020, and no dividend at all in 2021. But I don't blame them for this, because every company has to hold onto the cash in the difficult times such as COVID. In 2022, they distributed 20 cents per share, making the dividend yield 2%. In my opinion, the lack of dividends in 2020 and 2021, along with poor operations in 2020, caused a sellout and therefore the decline of the stock price, because many investors want dividends, so they just sold out this stock and moved to another dividend stock. Now let's forecast 2023 numbers and find out the return investment ratio if we buy the stock today. If you are new to this channel, I look for a relation between the revenue and some other element in the financial statements to forecast the revenue more accurately. In this case, the inventory turnover ratio has been somewhat consistent the past few years. This ratio simply tells us how many times the company sold and replenished all of the inventory in 1 year or 1 period. Or in other words, how many revenue dollars are generated from one inventory dollar. When we compare this ratio in the past 2 years, we can see it grew in 2022. But to be conservative, let's assume that the 2023 inventory turnover ratio will be the same as 2022, which is 5.65. And because we know the inventory at the beginning of 2023, in my opinion, 2023 revenue will be around $3.4 billion. The free cash flow will be around $150 million, using a 5% discount rate and a 5% return investment ratio. In my opinion, the intrinsic value of the stock is $43.47, which means that the stock is 77% undervalued. And if we change the return investment ratio to 21.9%, the intrinsic value of the stock is almost the same as the current stock value in the market. In my opinion, 21.9% return investment ratio is a good deal for value investors, and it's possible that the dividend will increase in the future, which could attract more investors to own the stock. In a few days, the 2023 Q2 report will be available to the public, so let's wait and see by how much the report will move the stock price and which direction. I hope you learned something new about this company. If you did, please subscribe and maybe leave a comment and like this video.